So the upper asset valuation zone is a sell zone. It's only a sell zone if we're selling back into the range of yesterday. The lower asset valuation zone is a buy zone. It's a buy zone if we're buying from the low of yesterday. Because when we closed yesterday, the market said this was the highest valuation that we permitted this asset to be valued at. And the market also said down here, this is the lowest asset valuation. So anywhere between here, bulls will be prepared to push the price back up to the higher valuation zone. Bears are going to defend this and say, but hang on a second. Yesterday we said this was the lowest valuation. We're not going to accept anything else. Up here, this was the highest asset valuation. So bulls are going to defend this to keep the market from going above this. So when we look at it just from static, the upper valuation zone measured by this high of yesterday is a sell zone back into the range of yesterday. So if that structure you showed me was occurring within here, high of yesterday, and that last sell signal was beneath the high of yesterday, we would be selling. But what you showed me was way above here. That's a completely different strategy, and we'll talk about that. In the midpoint, it's either buy or sell. Okay, if we see our strategy setting up, we can buy all the way to the high of yesterday. If we see our strategy setting up, we sell all the way down. But the key thing at the static levels, at the high of yesterday, as long as the market gives us a structure beneath the high of yesterday, we sell. If it gives us the right structure above the low of yesterday, we buy. Very, very, very strong forces controlling the market that we can follow in buying or follow in selling. But the key is, where are we in relationship to the highest valuation of yesterday? Because this zone here, a little bit above, a little bit below, is a sell zone. It only becomes a buy zone if the bulls are strong enough to break out above you with such force that we see it in a strong trend candle. Then we buy. But we'll come back and have a look at that. So this is key. If we get all those three revaluations, we're going to sell. If we get the three revaluations, we're going to buy. But let's have a look at a little bit more. So when do we sell? This is the upper valuation zone. It's a sell zone. I see a revaluation here, another one here, another one. There could be 3 to 5. But if I'm going to sell, the last one has to be beneath the high of yesterday. Bear breakout trend candle beneath the high of yesterday. After I see three revaluations, I sell all the way down. That is one of our strategies. So what we look for if we're going to sell in the upper valuation zone, 3 to 5 distinct revaluations at high or higher asset values. The last one, and evidence of bear strength, must be below the high of yesterday. The signal will be a bear breakout trend candle. In other words, asset is too expensive and sellers want to sell. If you can't see 3 to 5 distinct revaluations, do nothing. Now, what do you look for? What is a revaluation? I'm saying look for signs of asset revaluations, areas where price distinctly turns down or turns up. What does a trader see at a revaluation point? The best price action patterns at the point of turning down or turning up. Although Simon underlined, it is not necessary to study the forces at the turn. Don't have to worry about it, just have to see, oh, the price has turned. Sometimes you'll see, oh, there was a bear high test. Bulls tried to go up, bears sold. We have one bar. It could be one bar where the price has turned. Okay, it could be a huge, breakout trend candle. Market is going up and a huge candle reverses everything. Or it could be two bars, double top. The second one is a bear. Market goes up, immediately comes down, or market goes up, maybe there's another little dodgy bear candle in between. And then we have a bear trend candle. Double top. You can see two bars that are created at the top. The second one has to be a bear. Or it could be a wedge. Wedge is simply three bars. in a sequence of 3 to 6 bars. You know, goes up once, comes back again, goes up again, comes back again, goes up again. Three distinct turns within 3 to 6 bars is a wedge. The last one has to be a bear, or it's just multiple bars, sideways price action, but the last is a bear. All of these are revaluation points. All we need to do is just see or the market has turned, whether it's 1 bar or 2 bars or a big candle or a wedge is irrelevant as long as we see the 3 to 5 revaluations saying to us that the market is rejecting higher prices. Similarly, buy zone all the way down here. Buy zone to buying back into the range of yesterday. 1, 2, 3. Bears are trying to sell, they fail. Try to sell, they fail. Try to sell, they fail. But they've got to try again to sell above the low of yesterday. And if they fail here and I see one of those revaluation points and I see my bull breakout trend candle, then I buy back into the range of yesterday. Okay, so what we look for in the lower AVZ, 3 to 5 distinct revaluations at low or lower asset values. We're always looking for evidence of strength because it's strong have a high probability of winning. The last one, and evidence of bull strength must be above the low of yesterday. The signal will be a bull breakout trend candle. In other words, the asset is too cheap. So the buyers want to buy. If you can't see it, it's not there, do nothing. Absolutely do nothing. What you look for as signs of asset revaluation as a recap, it's only where price is distinctly turns down or turns up. As far as we are looking to actually buy best price action patterns at the law of turning down, it is not necessary to study the forces. Okay, so we're looking for a bull low test candle. So now I want to buy. I've seen revaluation, revaluation, revaluation. I'm ready to jump in and buy. I have to see always a breakout trend candle. The last one must be a bull candle, the signal. Could be one candle, could be one big candle, huge bull candle, could be double bottom. Tried once, tried again, but I'm looking for the second candle is a bull candle. Could be 3 turns, 1, 2, 3. That's a wedge. As long as the last is a bull candle, happiness. Or we'll just be going sideways. As long as I see that bull breakout candle, then I am happy to jump in and buy. Footprint number 5. We're looking to trade the energy shift from one valuation from the upper AVZ to the lower AVZ. Okay, that's what we're looking to do. We're looking to trade energy. That's what we're looking for. When the market has given us drama and these things are happening, that's when you want to jump in. When price starts to decelerate down to 0, that's what the bears want. The bears, if the market is at 20, they don't want to get to 15. They want to get to 1 and make all that money and then jump out quickly before it just shuts down completely. When price starts to decelerate down from the upper AVZ, we sell with the strong bears. In kicks in strategy portfolio number 1. Remember we said upper asset valuation zone, selling back into the range of yesterday. When the market wants to decelerate down from the upper AVZ, we want to sell the strong bears. That is our strategy portfolio number 1. We are back here. The price is starting to decelerate down to 0. We want to sell with the strong bears. We want to jump in with the bears. As soon as we've seen all of this, and we're just waiting and waiting and waiting. Now, there comes the signal. Fantastic. I'm in the zone. I want to see a bear breakout trend candle close. One of those that we trade. Once I see that, so that whole structure you showed me on gold, if that all took place around the high of yesterday, not up there in the sky where it was, if it all took place, it's literally within this zone. You know, there's no big bull breakout trend candle if I'm going to sell. That's a different thing altogether. If I see that, you see the trend candle. Strategy portfolio number 1 kicks in, and I'll describe this for you so you can see how easy it is. I want to sell all the way down there. That is what I want to do. I'm selling strategy portfolio number 1. Footprint number 2, I want to trade the energy shift from the lower AVZ to the upper AVZ. When price starts to accelerate up from the lower asset valuation zone, I want to buy. Same strategy, but now I'm buying with the strong bulls. Same strategy, now we are buying with the strong bulls. I see all of that beautiful stuff. I wait. There they are. They give me a decent enough bull breakout trend candle. I want to buy. I'm using strategy portfolio number 1, but now I'm buying from the lower AVZ, buying up with the strong bulls. Boom, off we go. We are still trading within the range of yesterday because that's what was set for us as evaluation zones yesterday. Strategy 5, footprint number 5.13. We want to trade the energy shift above the upper AVZ or below the AVZ. So just like what you showed me on gold, we're trading outside of the range of yesterday, above the AVZ or below, above the upper AVZ, above the green line, or below the red line, the lower AVZ. When I trade that, or through the AVZ of indecision using appropriate strategy portfolios. Now, when price starts to accelerate up above the upper AVZ, we want to buy with strategy portfolio number 1. In strategy portfolio number 1, above the AVZ only kicks in for us 2 distinct times. Either there's a surprise breakout candle, boom, it's just happened. We don't know why it's happened. We don't care why it's happened. Big bull trend candle is closed above the upper valuation zone. We want to jump in and trade. Or is triggered by a red news announcement. You're watching your Forex Factory or FX News or whatever calendar that you use for news, and they tell you there is CPI, GBP CPI, whatever it may be, US CPI, non-farm payroll, doesn't matter. As soon as that news candle is closed, we see this huge bull breakout trend candle above the upper AVZ. Strategy portfolio number 1 kicks in and we trade that. It's very simple. Trading above the upper valuation zone is only with strategy portfolio number 1, only when there is a surprise breakout or it is triggered by the news. Then we are followed by strategy portfolio number 2. Strategy portfolio number 2, if I may remind you, because I know it's still fresh, this is when we are in cruise. In other words, a breakout has happened. It was so dramatic. I didn't take it or I wasn't there. But now I look and I see, okay, the market is broken up and we're staying above the 10 EMA. Whenever I see my dynamic level, the 10 EMA being tested and I get a breakout trend candle, then I jump into strategy portfolio number 2. I'm going to describe all of this for you just now. Now, Simon, to the chart that you showed me, if you have to sell when you're way above the high of yesterday after that bull breakout, we sell with strategy portfolio number 2. Strategy portfolio number 2 is after I have seen strategy portfolio number 1 and we're testing the EMA. Strategy portfolio number 1 is all about breakouts, dramatic breakouts, and acceleration into trend. So the only time I ever sell when I'm above the high of yesterday is when from up there in the sky, the market is coming down. First, I see a strong breakout beneath the 10 EMA. Could be 1, 2, or 3 trend candles. But I do nothing with it because I am way above the high of yesterday. There is so much risk that the bulls who have pushed the market above the high of yesterday are going to defend any attempt to come back. So I do nothing. I wait to see the market revaluing back at the EMA, the market coming back to test this new average price of sellers. When I see the market coming back to test the EMA, then I see a breakout trend candle saying we are resuming the selling. strategy number two kicks in. So the one that you showed me is not strategy number two. If I had seen two or three bare breakout trend candles coming down from above there, and then we come back to reevaluate the EMA, then I sell. Okay. When price starts to, I'm going to come back to the middle one. When price starts to decelerate down below the red line, the low AVZ, we sell the strategy portfolio. One, red news or a surprise breakout trend candle. And then after we've sold, the market is going to come back to the EMA. We, of course, going to want to wait for the revaluation at the EMA. Strategy portfolio number two is always at the EMA. Strategy portfolio number two is always off the 10 EMA. That never changes. That's whenever you hear me say strategy portfolio number two, you gotta say, okay, there was some breakout for whatever reason. Market has come back to test the average price of the 10 EMA. That's why Dr. George is saying sell or buy. Portfolio number two is always off the EMA. If you have to buy when below low of yesterday, buy with strategy portfolio number two. So this is the inverse of that. So there is a red line. If you're going to sell, is strategy number one. If you miss strategy number one, it comes back to test the EMA. Strategy number two, you sell again. If for whatever reason you see the market coming back up towards the low of yesterday and you want to buy, you only wait for strategy portfolio number two back at the EMA. If you have, that's why I highlighted, if you have to buy when below low of yesterday, buy with strategy portfolio number two, only buy off the EMA. When price is moving through the midpoint AVZ of indecision based on directional strength, trade with strategy portfolio number one. Now, this is very interesting. When the market is moving from the upper valuation zone to the lower valuation zone, or from the lower valuation zone to the upper valuation zone, we do absolutely nothing until we see strategy portfolio number two off the EMA. So we don't get sucked in or drawn in by all these dramatic breakouts happening in the valley of indecision. We are not interested. We just wait as long as price is moving from the high to the low or low to the high. We want to wait for the average value to be tested at the EMA. That's when we trade. So peaceful and relaxed. Before, I'll be trading all these breakouts in the middle, managing them, making money, losing money. It's not necessary. Just leave it completely. Get some beautiful Arabic coffee and enjoy that. Egyptian Arabic coffee. So, yes, this is absolutely important. I love this. Once we are trading, we have to actively participate in the market. This is who we are. We are traders. We are here to extract wealth from the markets. We have our strategies. They're very simple. When the market is moving, we have to actively participate as calmly and peacefully as we can. We have to work the trend. If we get the market giving us a trend, we have to work it between the first AVZ and the next, above the high of yesterday or low of yesterday. So it could be between the range of yesterday from the upper to the lower, from the lower to the upper. Fantastic. Or it's going above the upper to the sky or lower down to the depths. That is perfectly fine. We must actively participate in the market. We work the strongest part of the trend, strategy number one, and strategy number one at the open. Now, I described to you strategy number one, and strategy number one can occur at any time. And the clue to strategy number one is a big breakout trend candle, or maybe a series, 1, 2, 3 of good trend candles like the ones that I showed you in the image that add up to this big breakout. That's strategy number one. It is triggered by a surprise. It's just happened. I don't know why it happened at the level that I was looking at, or there is red news. Okay, that's what triggers it. If it's going above the high or below the low. But if it's within the range of yesterday, it is still the surprise, the red news, and the breakout. But you can also see the revaluations. So the revaluations are always core. trading from the high to the low, low to the high. Plus, of course, you can get red news or surprise. So let me recap. Strategy number one. All our strategies, let me say that, we have to see distinct revaluations around AVZs. Strategy number one, we're going to see 2, 3, 4, 5 revaluations. If we are trading at the open of indexes, the dramatic breakouts happens at the close of that first index candle. If we are trading outside of the indexes, we will see the breakouts at any time, but the process is still the same. The only thing to bear in mind is that if we are breaking above the high of yesterday or low of yesterday, there must be something that's giving energy to the markets, either a surprise breakout. Someone said something, someone did something, we don't know what, but it's created this big breakout, or it's a news signal. If we miss number one, that's fine. Just wait for it to come back and revalue at the EMA. Strategy number two, all the while you manage our risk and optimize profits throughout the journey. Hoping now this will start to make some sense. Strategy portfolio number one is exactly a strategy portfolio number one. I don't know what that meant. Let me start again. Strategy portfolio number one at the open is exactly the same as strategy portfolio number one. The difference is that number one at the open is you are trading indexes at their specific exchange opening. That's the difference. Whereas when you're away from an index opening, strategy portfolio number one can be from the upper to the lower, or can be from the lower to the upper. That's what this means. Based on the same structures, if we're going above the high of yesterday, it's just surprise or red news or at the open. Let's look at it down here. Strategy portfolio number one can occur at any time from the lower to the upper at any time. Anytime. Get your 3 revaluations, middle of the day, boom, you get your trend candle. At any time, you can go strategy portfolio number one from the lower to the upper. If you're trading an index, strategy portfolio number one kicks in at the open. You have a specific way to look at it open. If the open passes, and the open is usually determined as the first hour and a half of an exchange opening. That's what the market considers the open of any market, the first 1.5 hours. After the 1.5 hours is done, you can still look at those charts, and now you're only looking at strategy portfolio number one that can occur at any time from the lower to the upper or the upper to the lower. If the market gets beneath the low of yesterday, you are no longer within the range of yesterday. You need significant energy to move things. And the significant energy for strategy portfolio number one at any time is either just a surprise that occurs, that is evidence of a big breakout trend candle closing on its low, or is triggered by red news. So this can happen at any time or red news. Another pent up energy that can lead to a break beneath the low of yesterday is at the open of indexes. So you either get those strategy portfolio number ones. If you miss that, you wait for the market to get back to the EMA, the 10 EMA, and in kick strategy portfolio number two. If for any reason you have to buy from down here to up there, it's only strategy portfolio number two. There is no strategy portfolio number one of any kind that we're going to trade going into the low of yesterday. That's not going to happen. That could be a trap. You could see big trend candles jump in and you lose money because the bears are all out in full force to keep the market down there. So you wait for the breakout. You wait for it to come back to the EMA. When you see that, then you can take strategy portfolio number two. If there isn't, ignore all the beautiful breakout trend candles by the bulls. If we come up here, exactly the same thing. Strategy portfolio number one, either at the open or some drama, and then portfolio number 2. So that gold chart you showed me, it seemed like there was a big bull breakout trend candle somewhere, maybe Asian session, who knows? Then surprise candle or red news, you buy that. Then you wait for it to come back to the EMA, you could trade that. But coming down here, we wait to see a strong breakout. 1 big candle, 2 big candles, or 3. That then comes back to the EMA after we've seen the strength, and then we see another trend candle, we come off that and we trade that. That's all we do. Now, there is another way to trade the value of indecision, and I'll describe the rules to you. It's very simple. If the market opens in the midpoint and stays in the midpoint, and then we get our trend candles, we can go up or go down, but only if it has opened and stayed in the middle. If it's coming from the top, from the upper to the lower, we only work with strategy portfolio number 2 in the value of indecision. If we go in from the lower to the upper, only use strategy portfolio number 2. So we're going to describe this a little bit more for you. Remember, clean, naked charts. It can't be anything else cluttered in our charts. We're not interested. Clean up everything so everything is pretty clear. Static levels of valuation, dynamic levels of valuation. We have spoken about this. This is the work that we do. That's part of our business. But we have 4 distinct strategy portfolios, easy to grasp and master when trading. Are you ready to become masters of price action trading using the AVZ? Let's dig a little bit, give you a bit more detail. Remember the pilot analogy? The AVZ are going to tell us someone when to participate in the market to trade and when not. If it doesn't set up, do not trade. I don't know how many times I tell my traders that, and they send me questions. I say, but what are you doing? It's not anywhere in our AVZ, or it's not set up. Just walk away. Rather not trade for the day. Come back tomorrow and make your money. Strategy portfolio number 1, beautiful takeoff. Trade at any time, right? If you get your 3, 4, 5 valuations, or there's red news, or there's surprise bar. In cruise, in other words, in cruise means we are already after strategy portfolio number 1. In comes number 2, off the EMA, trading junior strong trend. Air Force takeoff at the open of indexes. And then risk management, things that we have spoken about. Here is the detail. Strategy portfolio number 1, inside the range of yesterday, from the upper to the lower or lower to the upper. The market takes off at any time, in any market. It also includes red news or surprise breakouts that can still occur into the range of yesterday, down from the upper AVZ and up from the lower AVZ. The market has decided to accelerate or decelerate from one AVZ to the next, upper to lower or lower to upper. You've seen your 3 revaluations, and you've seen the last one beneath you're looking for the last one, and there it is beneath the high of yesterday or above the low of yesterday. For takeoff, the alert signals you want 1, 2, or 3 consecutive breakout trend candles. You are ready to go. You've got to see a breakout trend candle. If it's not there, doesn't matter how many revaluations you have set, it is not there. So either the first, second, or third breakout trend candle. When you ask questions and you're sending me things to, I'm going to ask you, where are my 3 revaluations or 4 or 5? And then you say, oh, there they are. I'm going to say, but where is the breakout trend candle, the last signal? If you're undecided about breakout strength, then best to wait for strategy portfolio number 2. If you can't see it, just wait, walk away. There's nothing to worry about. Here is strategy portfolio number 1 at the open. At the open of indexes and index-specific red news and large surprise breakout trend candles. Now, be on the lookout for currencies as their specific country indexes open. So I'm trading the UK 100, but I've also got pound USD. So while I'm watching UK 100, the country-specific currency for that index, anything to do with pound, I have to watch it. If I decide to trade pound CAD, then I have to be very careful when the US markets open because the CAD might do something dramatic that influences pound CAD. So indexes and currencies, they're specific country currencies. Strategy portfolio number one, trading the open. We're looking for the first candle that opens on its high or low. That's very important. When you're watching that candle, has it opened on its high or low and started moving? Okay, so if it's a bear, a bull candle, if it's open on its high and starts bull candle, bull candles, George, don't open on its high. If it's a bear candle, it opens on its high and sells and sells and sells, and then closes on its low, I want to jump into that trade. If it's a bull candle, it opens on its low and buys, 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 and closes on its high, I want to buy. A small candle, I just call it less than a quarter tail. You don't have to measure. You can see, oh, that's a small candle. That's a small tail, wick. That's good enough. You buy or sell the breakout, and then you can look to scale in or add in, whatever you call it, after break even. Another one at the open. The first candle opens with a big tail, or greater than a quarter tail, big tail at the open, but closes on its low or high. This is very important at the open. Closes on its low or high. Everything, if you just remember, closes on its low or high. No tail, then you want to jump in. If you have a big tail at the open, you don't want a tail at the top. So market opens here, goes down, comes back to the open, goes up. So it's a bull candle, must close, and it's high. But it's going to tail at the open. I'm happy to buy that and manage my trades. If you have a tail at the bottom, tail at the open, do nothing. It's a trading range, it's a doji, you don't want to touch it. If the first candle becomes a doji, in other words, it's got large tails either side, wait for its measured move breakout. Wait for the market to get to the measured move of that height and then reassess the strengths. Very simple, very clear, but you have to be very strict with yourself. Is this thing opening on its high or low? Is it closing on its high or is it a big breakout trend candle with very small tails? Yes, jump in. Does it have a big tail at the open? And I want to sell, okay, it's a bear candle. I don't want a tail on the close. Then I want to jump in and sell. Very simple, but traders bring in a lot of things in and they start to make sense. Keep it simple. It is really simple. If it's not in the rules, do not touch it. Strategy portfolio number one, middle to upper or middle to lower. That's when I say to you, the market is opened in the middle. Now, it only takes off at red news or surprise breakout. That's all we are looking for. If the market is opened within the AVZ of indecision, opened in the middle, and it is still within this zone, but somewhere, if you look to the left in the Asian session, or if you come in at the US session, the London session, there's evidence of 2 to 3 breakout trend candles. Some evidence that you can see, oh, the bulls appear stronger in this middle indecision. Then you got to wait for the bulls to confirm that they got strength. Or if it's the bears, you got to wait for the bears to confirm that they got strength. The market then decides to accelerate up from the middle of indecision to the upper, so we're going up, or from the middle to the lower, we're going down. Red news or surprise. We're only going to trade one candle from the middle to the lower. We're not going to add in. We're not going to look for pullbacks, nothing. If the market has been in the middle indecision, and then we get this breakout signal, either at red news or as a surprise, we only take one trade. That's it. And then we wait for the market to get to the extremes of the low or the extremes of the high. If you're undecided, you hear me say this over and over and over again. BTW means best to wait. If you're undecided, best to wait, best to wait, best to wait, 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 wait. And finally, strategy portfolio number two. Well, I'm saying finally. Only, this is key, only, Simon, only when you can clearly see strategy number one or strategy number one at the open. Whether you have executed it or not, it doesn't matter. but you have to see strategy number 1 or strategy number 1 at the open. Or if you can't clearly see dramatic breakouts up or down with each of these, but you can see that there's a gradual upward or downward trend in effect, then you look for strategy portfolio number 2, because sometimes none of our strategy 1 is there. So there's no dramatic breakout trend candle. There's no strategy number 1 in the open. Nothing dramatic happened at the open. But you can see the market is gradually going up. It's doing all these funny things, going up, coming down, but it is moving upwards. Or you can see the market is moving downwards. When you see that and you want to jump into the market, in your mind, you got to wait for strategy portfolio number 2 to set up, which is very simple. A strong trend is unfolding and the market wants to test commitments at the average price, the 10 EMA. Or it might want to test it yesterday's extreme. So it's coming from, like that example that you had. It's coming from the top above high of yesterday, and you just can't find a way to go. It breaks beneath the low of the high of yesterday. It comes back to test the high of yesterday, then you can jump in. That is strategy portfolio number 2. Either we're testing the average price or we're testing yesterday's extremes, high of yesterday, low of yesterday. What we're looking for are 4 simple things. 1, revaluation. Be 1 or 2 candles. Remember, I told you what to look for. It could be high test, low test, whatever. 1, revaluation, 1 or 2 candles. Testing, but not breaking. None of the things at strategy portfolio 2, they do not break the 10 EMA. If they break the 10 EMA, we put up our hand and we say, I'm going to get some coffee, a Coke, whatever. I'm not trading. Why did we break through the 10 EMA? That is the indicator of strength. So that means the strength is weakening. So I'm not interested in weak things. I'm going to wait. But if the test doesn't break the average price, then just wait for resumption of acceleration up or deceleration down from the EMA. You've got to find out breakout trend candle. Some guys just want to, as soon as it hits the EMA, they want to buy or sell. Do not do that. Wait to see evidence that we're going to resume acceleration up or deceleration down. Look for a breakout trend candle. So sometimes it's 1 revaluation, sometimes it's 2 revaluations, 2 or 4 candles. We test the EMA, we come back, we test the EMA again. Or the first test is away from the EMA, the second one is closer to the EMA. Doesn't matter as long as it's not breaking through the average price or the EMA. Then we wait for resumption of acceleration. We always are looking for our breakout trend candle. We always are looking for the breakout trend candle. Again, EMA, sometimes 3 revaluations. 3 times the market is trying to test that average price, but it's not breaking through it. And the last one, of course, will be closer to the EMA. We wait for the resumption or acceleration. And before we trade, we always look for our breakout trend candle. And sometimes the market goes up and just comes back and tests in sideways, sideways, sideways. It's a sideways, tightly contested revaluation, any number of bars, a tight trading range, testing but not breaking through the average price. Same thing. As long as it doesn't break the average price, wait for resumption or acceleration of the EMA. Look for that breakout trend candle before you jump in. Here is a description of the strategy portfolios 1 in the open, and 2. We'll talk about risk again. We're coming to the close of this session. Take our 10-minute break, and then we'll come back into Teams for Q&A before we go into the next session. So we'll see you in 10 minutes from now at 52. All right, Simon, take a break, come back, and we carry on.
Thank you. Bye.